So if you're interested in investing passively in multifamily syndications, you might be curious as to how these deals are structured. You may have heard straight equity, preferred. You might be wondering what kind of returns are they and what are the trends? And those are the things that we're going to talk about in today's episode. And to help me with that is our Director of Investor Relations, Bronson Hill. What's going on, Bronson?
What's up, Michael? Hey, just trying to survive over here. Excited about being with you today. Hey, some questions that do come up on calls, and I think a lot of passive investors have, is just how is all of this structured? How are deals structured passively for investors?
Right, there's different ways that are out there. We have done it one way, others have done it other ways. So, one way the way we've done it is what's called straight equity. Straight equity is just simply it's a 70-30 split or 80-20 split or whatever the case may be. And that means that the investors who basically bring in 100% of the money get, say, 70 or 80% of the deal, and the rest is awarded to the general partners who put the deal together and who are managing the deal. And that's typically the way we've done it, and a lot of other people do it as well.
So, Michael, what are the pros and cons of that straight equity structure?
Well, number one, it's very simple, right? It's a 70-30 split, 80-20 split, whatever the case may be. Every money that comes in that's a distribution or profit or sum of whatever the case may be is just simply split pro rata. And so it's very simple. The cons could be that, especially from the investor perspective, there seems to be some element of risk, meaning that if the deal doesn't perform, they don't really get paid, and it's possible that in their mind the general partners might get paid and they don't get paid, and which is actually not true. There is this other thing called a preferred return, which we probably have to talk about to look at the pros and cons. The other is something called a preferred return, and that is essentially almost like interest. It gets paid out first. There's a bucket of, let's say there's $100,000 profit, and the preferred return is, let's say, 8% or 7%, whatever the case may be. Then out of the 100,000, the first 7%, the first 7,000 is then returned to the investors, and then whatever is left is now split 70-30, 80-20. That's kind of how it works. So those are two different ways of doing it.
Yeah, so I know that these are very different ways of doing things, but what are the pros and cons of the preferred return?
Oh, I see. So I didn't quite answer the question. Thank you for reminding me. Yeah, the pros and cons. So the pros from the investor is that there's a certain amount of money that they get paid first. In other words, it's almost like a hurdle rate. If the property doesn't perform as expected, then the investors get paid first and the general partners don't get paid anything. In other words, the general partners only get paid if they're at or above their projection. And so from an investor perspective, it might sound like this is a good thing, and it does sound like a good thing. But here's the honest truth. The honest truth is it's actually not good for the investor because it's not good for the general partners. Here's what's been happening over the years, and some investors have been through this where they've invested with deals that have preferred rate of return. Well, the deal sometimes doesn't perform as it should, especially in the first 12 to 18 months, right? There's a value add, and maybe the construction costs are over. It takes long to lease up. And so in the early days, there's this giant pressure to distribute cash, which when you're trying to build value is actually directly in conflict of that. So the general partners are in this conflict. What should I do? Should I use this money and invest it in a deal so we can hit our long-term goals, or should I distribute this cash to the investors to make them happy? And what happens with a preferred return is if there's not enough cash to go around, then there's this what's called a deficiency. So if the deal doesn't go quite as planned and there's no cash to distribute, it still accrues. You still have a 7 or 8% that accrues that year, and you then have it goes over into next year. And so next year now, let's say it's getting a little better, but it's still not enough to cover what second year pro forma was. But now you have a deficiency from the year one. So what could happen is that the partners never catch up. They actually never catch up. They can never make money. So in other words, what's happening is they're essentially working for free. And you know what happens to people who work really hard for no money at all? What happens to people like that? Do they keep trying real hard, or do they maybe try a little less hard?
Yeah,
So
that slows them down.
And
For
so
sure.
this is why my argument is that a pref actually is not good for the investor either, because the misalignment. This is why we really like the straight equity, because the thing, if we're not making money, the investors aren't making money. If the investors are making money, we're making money. We're actually really, really aligned. And there's also, we're not being pressed to distribute money in a straight equity. In other words, if we have to reserve cash for whatever reason, this pandemic we're in right now is a perfect example of that. oh my gosh, I'm so glad we don't have a pref right now. And there's a lot of syndicators who do have a pref right now. We're not distributing anything, not because we can't. We actually have plenty of money in these deals, but we're not choosing to because we don't know if we need it. Right? So if we do need that money, it's really good to have. And if I had a deficiency, the time is my enemy, I would now have to, if I feel pressure to distribute that money, and that's bad. Okay, I'm going to make bad decisions. Also, if the deficiency gets too big and I never make any money until the very end, I may feel like I should sell prematurely. Right? And I've seen that happen too. It's a 5-year hold to maximize the value for everybody, but I'm not getting paid for another 4 years. I might kind of maybe if I can sell and maybe return the capital to investors and maybe give them a little cherry on top and maybe not quite my returns just so I get paid at the end, that may be a good thing, but may not be good for the investors. Therefore, my argument is that a pref is actually not aligned between the investors and the partners.
Yeah, so I know there's a lot of information here and people listening. There's a lot of different ways people structure deals, but maybe you could talk for a little bit about kind of what we've done at Nighthawk. Obviously, we've done no pref, we've done more of the straight equity, but what are some other things that we are considering and kind of why we're looking at some of these different options?
Well, first let me say, before we get to there are people who are doing a mixed approach, okay? So we talked about straight equity and pref, but there's also a mixed approach. And that gives the investor a certain preference. For example, some investors really want certainty, and they may gravitate towards preferred return, and they may not want a giant pop in equity at the end. Then there are other investors who care a little bit less about the cash flow, but they really want to build wealth, right? So they want that 20% IRR. They want to know when they put in $100,000, they're going to get $200,000 back in year 5. That's all they care about is these chunks of wealth that they're creating. And there's not necessarily the same kind of investor. So some syndicators are doing a mix where they have a Class A share and Class B share, and the Class A share maybe has more of a preferred return, and maybe that's the only thing. So for example, there could be just a 8% preferred return and nothing else, right? So these investors get an 8% every single year, almost like interest payment. Now, they don't participate in the upside, but that's okay because they're making a fairly certain 8%. The other kind of Class B do not get a pref at all, but they may get that 70% split or 80% split that we talked about. So they may get cash flow if there's stuff, but they're going to get the major pop on the end. So giving investors the option is something that people are starting to do, and we may do the same thing. Back to your original question, we may want to do some mix of the two to give investors a choice. What do you want? Do you want a little bit more high degree of certainty, or do you want a higher probability of profit?
That's great. Thanks for sharing that. I know there's, like I said, there's a lot of pieces moving in this. And so let's talk for a minute. Obviously, we've entered the world of COVID and post-COVID, and as people watch this in the future, but where do you see returns going over the next year or so for investors, Michael?
Yeah, I mean, they have gone down, and they have gone down over the last 2 years. Obviously, by necessity, as prices have gone up, they have gone down somewhat. And one reason that syndicators are struggling with finding deals for the investors is because we're trying to maintain that return that we got 3 years ago, right? And so it's very rare, unusual, and it should be a red flag if you're seeing deals in the 17, 18% IRR with 10, 12% cash on cash. You should be scratching your head going, yeah, I don't know about that. I should maybe ask some questions around the assumptions. So the returns have been going down. I will tell you, I think it's collectively better if the returns continue to go down somewhat. First of all, if they go down to, I'll make it up, a 12 or 13% average annual return or IRR, that's still significantly higher than anything you get in the stock market, number one, and you're not even paying taxes on that. And so you're already light years ahead of the stock market return. Now, if we can all settle for slightly lower returns, we can actually buy more stuff. If we can buy more stuff, the investor has more deals to look at, can invest more consistently, more predictably versus one time here, now I got to wait a year and then another one. Also, you're spreading your risk, your money around between different deals. So the returns have to go down or have been going down, and will probably continue going a little bit. Again, I say not much, but the expectation should be a bit lower. If we can all set expectations a bit lower, there are certain investors who are simply selling a 6% preferred and then a 6% at the end. So it's just a straight 12% return that they're selling, and 6% is now and 6% is accrued later on. So it's a different hybrid model as well. And investors like that because they get 12% essentially, not guaranteed. We can't say guaranteed, but that is kind of the plan. There's a high probability. And again, With that kind of cost of capital, the syndicator can now buy nicer stuff in nicer areas, reducing the risk and increasing the deal flow. So I think it's something that we should all take a look at.
Yeah, I agree. I mean, I think sometimes when it comes to the conservative underwriting and just really making sure the numbers work, I'd rather have a lower number that actually people can perform on than something just looks great on paper and can't really get there. So, Michael, thanks so much for being here today and sharing all of this information. It's really good to understand the structure of how these deals are structured when it comes to returns. So for you listening, thank you for taking the time to join us today. The biggest investment you can make really is in yourself, and we say that, but it's really true. So thanks for being here with us. We wanted to say, Michael mentioned this as well, but just when you're comparing the stock market and multifamily investing, there's really no comparison. And Michael put together this awesome report. It's at themichaelblanc.com/report. Please go check it out. I think you'll learn a lot. It's really, it's a very eye-opening way of kind of seeing how multifamily syndication can really benefit you. Secondly, if you're interested in taking the next step with us, go to nighthawkequity.com, click the join button. You can get on our investor list, and we'll let you know about upcoming deals that we have. So again, thanks for joining us today, and we'll see you on the next video.